January 11th, 2024. The New York Stock Exchange. BlackRock's Bitcoin ETF IBIT opened for its first day of trading. Fidelity, ARK Invest, Invesco. The marquee names of Wall Street flickered across the screen. An asset that banks and brokerages had shunned for decades became a Wall Street product. Before this clean financial product appeared on exchange screens, 600,000 people had to lose everything. 2 explosions, 2 geniuses, 2 promises. The promise that code could replace trust. That promise vanished, code and all. One genius's algorithm collapsed in 72 hours. More than a full year of South Korea's defense budget, $60 billion, disappeared. Another genius's exchange siphoned $8 billion in customer funds into a sister company's account. The GDP of an entire small city became one man's betting capital. Who designed the trust? Who burned? Who claimed the largest seat on the wreckage? 3 years of record, from 2022 to 2024. Rewind to 2020. The U.S. Federal Reserve slashed interest rates to near zero in the wake of the COVID pandemic. Bank deposit interest, 0.1%. Excess liquidity flooding the world moved in search of higher returns. The crypto market was where that capital ended up. This was the seed paradox. What the near-zero rate environment created was a thirst for yield. That thirst made the number 19.5% believable. A number that looked abnormal appeared normal inside an abnormal rate environment. The institutional void became the nutrition for a Ponzi. In that very period, a man named Kwon made a declaration. Code can replace the central bank. Stanford computer science graduate. Resume, Samsung, Apple. In his early 30s, he founded Terraform Labs in Singapore. In the crypto world, he was called a genius engineer. What he built was Terra USD, UST, a stablecoin pegged 1-to-1 to the dollar. Normally, dollar-pegged coins stack actual dollars in a bank account. UST was different. No bank account, no vault, no state guarantee. A promise to maintain $1 through algorithm alone. Code began to mint trust. The structure was simple. To create 1 UST, burn $1 worth of Luna. To destroy 1 UST, mint $1 worth of Luna. Arbitrageurs would close price gaps, automatically balancing the 2 assets. The logic went. Instead of a central bank adjusting interest rates, code controlled supply and demand in real time. But this structure only worked when markets were calm. When fear arrived, the story changed. UST sells leads to Luna supply expands. Luna supply expands leads to Luna price falls. Luna price falls leads to UST collateral shrinks. Collateral shrinks leads to confidence in UST waivers. Confidence waivers leads to more UST sells. 2 assets pulling each other, converging to zero simultaneously. Economists named this structure death spiral. From the day UST came into existence, this name lived inside academic papers. 2018. No one said it out loud. Or if they did, no one listened, because the promise that code could replace trust rang louder. Binance Labs put in $4 million. Polychain Capital, Galaxy Digital, Hashed, followed. By 2021, the total VC funding Terraform Labs had raised exceeded $180 million. The world's most prestigious names stamped it with a seal of approval. The public read those names as technological validation. In reality, it was capital riding an opportunity. There was a device that made people believe this promise, the Anchor Protocol. Deposit UST and receive 19.5% annual interest, 195 times the deposit rate at commercial banks. It was called the benchmark rate of DeFi. Yield guaranteed by code spread across the world. It was not a lie, but it was not a sustainable promise either. This was the structural paradox. Depositors into Anchor multiplied explosively, but borrowers from Anchor did not grow at the same pace. A structure where outflows exceeded inflows, Terraform Labs injected external capital to cover interest. The more new investor deposits came in, the more interest piled up. The more reserves they added, the faster deposits grew. A Ponzi structure built on code. Yet capital loved this structure. Late 2021. Luna hit $119. Market cap, $40 billion. Global rank, 7th. A number equal to 1/4 of Tesla's market cap sat atop a single line of code. In Korea alone, 280,000 people held Luna. That number matched the entire population of Seoul's Mapo district. Some took out mortgage loans to put in. Some moved their retirement savings. Some entrusted their children's tuition. Some moved their entire assets, trusting the 20% yield. The numbers code promised became life plans. An online community called Lunatics emerged. They worshipped Do Kwon like a prophet. When researchers pointed out the system's risks, they mass-posted mocking replies. When a NYU economics professor analyzed UST's structural vulnerabilities on Twitter, Do Kwon replied directly, "I'll bet you $1. Faith has no falsification. Doubters became the insufficient ones." At the same time, in a penthouse in the Bahamas, another world was being built. Sam Bankman-Fried, SBF, MIT physics graduate, a man known as a fervent supporter of the effective altruism movement. His exchange, FTX, was the world's third largest crypto exchange with billions of dollars flowing daily. Sequoia, SoftBank, Tiger Global, top-tier investors lined up. Forbes put him on the cover as a billionaire at 30. He was the second largest individual donor to the U.S. Democratic Party. February 13, 2022. FTX ran a Super Bowl ad. Comedian Larry David appeared. As a man who dismissed every great invention in history and missed out. The wheel, the light bulb, the toilet, the internet. In the final scene, he rejected FTX too. The ad's message was a twist. Don't miss out. The ad cost $7 million. On the very day the ad aired, there was no CFO inside and no independent board. First half of 2022. Total crypto market cap exceeded $2 trillion. Crypto investment posts appeared in Gangnam real estate community forums. Bank tellers started hearing customers ask, "Do you know what the Anchor protocol is?" The apex of code becoming a religion called trust. On the very flip side of that apex, a crack. The night of May 7th, 2022. A crypto analyst published Anchor Protocol's reserve balance data. $35.7 million. The reserve balance to pay interest on $9 billion in deposits was $35.7 million. At the same moment, a signal fired in the Curve DeFi pool. Terraform Labs withdrew $150 million in UST from that pool, citing liquidity rebalancing. The shield thinned. May 9th. UST fell below $1, $0.98, $0.95, $0.87. The arbitrage mechanism triggered. People poured in orders to sell UST and swap to Luna. Luna supply exploded. Luna price collapsed. As collateral shrank, UST collapsed faster. The death spiral began to actually run. Luna Foundation Guard tried to defend UST with its Bitcoin reserves. $3.5 billion in Bitcoin poured in. Not enough. The moment the defense mechanism flipped into a collapse mechanism, Luna's circulating supply swelled from hundreds of millions to trillions. At the same time, the account screens of Luna holders updated in real time. From $119 to $50, $50 to $10, $10 to $1, $1 to $0.01. The speed at which numbers changed couldn't keep pace with the screen refresh rate. A month's salary, gone in hours. May 13th. Luna, from $119 to $0.00001. UST fell to 15 cents, and the entire ecosystem collapsed. $60 billion vanished into the air. The trust code promised evaporated, code and all. It was exactly the name written in the 2018 paper. The death spiral was a foretold collapse. Screams appeared in Korean communities. "All my assets are gone. I took out a loan to put it in. I was trying to plan retirement with anchor interest." The coin held by 280,000 people fell to 5 decimal places in 72 hours. Trusting the yield code promised was not a crime. The structure hidden behind the code was the problem. In June, Kwon quietly left Singapore, then Dubai, the Balkans. While 600,000 people lost everything, his estimated personal assets, $2 billion. The man who said he'd bet $1 crossed the border. Terra's collapse didn't kill just one project. When hedge fund Three Arrows Capital, which had bet heavily on Luna, started wobbling, Celsius and Voyager, who had lent money to it, collapsed in sequence. Celsius stopped withdrawals on June 12th. Voyager filed for bankruptcy on July 5th. The structure within the crypto ecosystem that had been bound together by mutual trust snapped all at once, beginning with one failure. 6 months later, the fear from that hadn't even faded. The market thought the Terra shock was passing. But inside that Bahamas penthouse, a hole the market hadn't yet seen had already been gaping for a long time. Terra was an event where a misdesigned algorithm collapsed. The code itself became the engine of collapse. FTX was different. This was a structure where customer funds had been leaking from the inside from the start. The two explosions had completely different characters. One was a design failure. The other was an intentional structure. But the effect they created in the market was the same. November 2nd, 2022. CoinDesk reported a leaked document, Alameda Research's balance sheet. Of $14.6 billion in assets, a significant portion was FTT tokens, self-issued by FTX. It meant they were covering liabilities with tokens they'd printed themselves. It took the market a few days to understand this implication. November 6th, 3:47 p.m. Binance CEO Changpeng Zhao tweeted, "Following recent revelations and lessons from Luna, we will liquidate all FTT holdings." One short sentence. That sentence simultaneously pressed the withdrawal button of every FTX account holder in the world. $6 billion drained within 72 hours. As FTT fell, Alameda's collateral value evaporated. SBF tweeted, "Assets are safe. Customer withdrawal requests did not stop." November 8th. FTX halted all withdrawals. Binance signed a letter of intent to acquire, then withdrew after just 1 day of due diligence. After seeing FTX's financial condition, it's beyond what we can help. The moment the last hope of rescue financing vanished, Bitcoin price crashed again. November 11th. FTX and 130 affiliates filed for bankruptcy. SBF resigned. John J. Ray III, who handled Enron's liquidation, took over as CEO. He wrote to the court, "In my 40-year career, I have never seen such a complete failure of corporate controls and such an absolute absence of trustworthy financial information." What investigations and court documents revealed of the internal structure was not sophisticated financial engineering. In FTX's system database, there was a parameter called allow_negative. Accounts with this value set to true could withdraw funds without limit, even with a negative balance. Among FTX's millions of customer accounts, the account with this value set to true was exactly one: Alameda Research. The maximum borrowing limit for a typical VIP customer was $150 million. Alameda's borrowing limit was set at $65 billion. The auto liquidation system was not applied to Alameda either. Cash deposited by customers flowed not into FTX's independent accounts, but directly into paper company accounts controlled by SBF. The GDP of an entire small city became wholesale, one man's betting capital. When those bets failed, there was no money left to return. The $8 billion hole had been there from the beginning. 2 explosions. What happened on the wreckage? Losses were distributed among hundreds of thousands of investors. Opportunity moved in a very specific direction. Crisis always repositions wealth. Let's track how this law operates, through 3 movements. First movement. Binance and Changpeng Zhao. CZ's one tweet triggered FTX's collapse. With FTX gone, the world's second largest exchange was removed from the market. Panic-stricken investors rushed to the largest surviving exchange. There were no other options. As of 2026, Binance's global market share, 39.2%. Cumulative users, 300 million. Annual total trading volume, $34 trillion. A figure matching the combined annual trading volume of NYSE and Nasdaq. In a market where the second-place exchange holds 8%, Binance alone holds nearly 40%. But CZ, who eliminated his biggest rival, also paid a price. In November 2023, Binance and CZ admitted to anti-money laundering violations, signing a $4.3 billion fine settlement, one of the largest criminal settlements in U.S. corporate history. CZ stepped down as CEO and served 4 months. The winner also paid. But Binance survived. Even after paying the fine, its market share went up. Those who exploited the crisis were also not free from the fact that they had stayed within that crisis. The survivor was the winner. The real movement was happening in a different direction, far more quietly and far more massively, the direction of Wall Street. Second movement, BlackRock and Larry Fink. In 2017, when Bitcoin was trading at $5,685, Larry Fink said this: "Bitcoin is an index of money laundering demand worldwide." As late as 2021, he said, "Our clients are not very interested in Bitcoin." After 2 explosions, BlackRock's stance changed. It was not foresight. It was moving after the 2 explosions had cleaned the market, the wisest way to open a shop on Wreckage. June 15, 2023. BlackRock filed a spot Bitcoin ETF application with the SEC, a firm with a record of only 1 rejection out of 575 ETF applications. BlackRock designed and submitted a market surveillance sharing agreement between Nasdaq and Coinbase, a structure to immediately detect if anyone manipulates prices in the spot market. They removed the SEC's grounds for rejection themselves. January 10, 2024. The SEC approved 11 spot Bitcoin ETFs simultaneously, including BlackRock's. In 7 weeks, $10 billion. In 18 months, 700,000 Bitcoin. $76 billion in market value, the fastest growth record in ETF history. Pension funds, sovereign wealth funds, institutional investors' waiting capital flowed in all at once. The irony lives in the numbers. Terra Luna collapse, $60 billion lost. FTX bankruptcy, $8 billion in customer assets gone. Total damage from both events, $68 billion. BlackRock IBIT's assets in 18 months, $76 billion. The gap the 2 explosions created, a shop the size of that gap moved in. The asset once called a money laundering index in 2017 now has a gatekeeper. This was BlackRock's timing. Third movement, the US SEC. 2 explosions gave regulators grounds for enforcement. The SEC executed 30 crypto-related enforcement actions in 2022, 46 in 2023. Fines levied, $4.9 billion, record high. Binance, Coinbase, Kraken. Every major exchange with a name became a prosecution target. It was an operation to obliterate disorder. That obliteration created an environment for institutional capital to enter. Kwon was arrested in Montenegro in March 2023, caught trying to pass through an airport with a forged passport. Extradited to the US in 2024, convicted in 2025. SBF was found guilty on all 7 counts in November 2023 and sentenced to 25 years. The man who launched Super Bowl ads, his end. The one who designed the code, and the one who manipulated the system from inside, both went to prison. On the wreckage they left behind, Wall Street is still doing business. The regulatory landscape changed too. The EU enacted the MiCA regulation in June 2024, the world's first comprehensive crypto legislation. One of the things MiCA explicitly prohibits: issuing stablecoins whose value is guaranteed by algorithm alone, without real assets. 2 years after Terra's collapse, the structure was outlawed. Korea enacted the Virtual Asset User Protection Act in July 2024. Exchanges must store more than 80% of customer assets in offline wallets. Customer deposits are entrusted to external institutions, separated from company assets. The experience of 280,000 investors who lost everything in the Luna crisis hardened into dozens of legal clauses. The time it took for an incident to become law: 2 years. Where code collapsed, law entered. Within the boundary of law, traditional finance took the keys to the crypto market. A world where if you want to trade, you go through BlackRock. If you want custody, you use Coinbase. The market that declared decentralization was reorganized by the most centralized players. Now let's see the full structure. The 2 explosions were different kinds of failure. Terra was the collapse of a misdesigned algorithm. FTX was the combination of customer fund misappropriation and internal control failure. One was a design failure, the other was an intentional structure. But the effect they created in the market was the same. Players who refused regulation weakened. Investor fear pushed capital towards safe platforms. The SEC gained grounds for enforcement. BlackRock gained space to enter. The designers went to prison. Those who manipulated the system from inside went to prison. The wreckage they left became the foundation. Code promised to replace trust. It became faith. It evaporated, code and all. In its place, law was erected. On top of law, Wall Street entered. That is the world greed built. When an algorithm claims to guarantee, the first question should not be about yield. Can I verify that promise myself? Are the assets I've entrusted actually held in segregated custody? And when that system begins to break down, can I get out within 72 hours? Terra and FTX left the same answer. A promise I cannot verify myself is closer to faith than investment. Faith pulls capital more powerfully than trust. But when it breaks, faster than trust, and far more completely. Neither Luna investors nor the hundreds of thousands who deposited into FTX thought they were practicing faith, not investment. That is the nature of faith.